Everything related to diversification is completely non-intuitive, and I think till date remains the only free lunch for reducing risk and optimizing returns at a portfolio level. Like in life, and so in the markets, one of the keys to happiness is basically just eliminating the mistakes that can easily be avoided. Over the past 20 years, I've seen portfolios with 10, 15 mutual funds. And assuming they're trying to make an actively managed portfolio, this actually completely works against you. There's a high chance you'll end up with lower than benchmark returns post your brokerage and fees. It also means don't get married to a particular strategy, stock, or fund just because it's had a great run in the past year or 2 years. Look to find those uncorrelated strategies that will cancel out the risk amongst each other but actually average out the returns, and that's a very powerful thing to do. Try and avoid running after a new shiny fund or a product that promises a higher return for little or no risk that is apparent. Very often, and especially all in mutual funds, there's significant overlap within the same category. So buying 3, 4 funds in, let's say, the mid cap space or the flexi cap space, as an example, actually does not contribute to diversification. You're only complicating your problems. In years like 2014, 2017, 2021, there was a significant contribution and rise up in the small cap space. We have seen time and often that instead of rebalancing to the prior risk level, we often increases exposure only to regret it a few months later. Now, if you keep doing a regular review with adjustments and maintain alignment to the original weights, that's probably a better way forward. Now that we've talked about what to avoid, let's talk about the free lunch. The world has really opened up in the last 5 years, and there are literally an infinite number of opportunities where your hard earned money can be put to use. Even in India currently, outside of the usual public equity, fixed income, and real estate, there are numerous avenues like solar, distress, commodities, art, private equities, MLDs, and I could just go on. So, don't stash all your chocolates in one melted pockets. And I know all of us have been there, haven't we? One of the other important things is diversifying globally. And this is something that all of us should look into. The newer risks tied to particular regions are now really swift, and the outcomes are now spread over even longer time horizons. However, within these challenges lies an opportunity whereby diversifying across different regions, countries, and maybe embracing a more global perspective, you actually position your portfolio to capture growth from various corners of the world, turning uncertainty into a canvas of potential success. Also, when buying into a particular idea, make sure it complements the other ideas of your portfolio. Buying more of the same and expecting a different result might not be useful to your money. Uh, to wrap things up, remember that diversification is the only financial superpower. By following the above steps, I think you could be more well equipped to build a more resilient and balanced investment portfolio. It's actually not about avoiding risks entirely, and nobody can do that, and nobody can promise that. It's just about managing them more efficiently. As a first step, I would say start by assessing your portfolio and eliminate the overlaps. Now, there should also be a subscribe or a follow button somewhere around here. And if you think this has been useful, please share and subscribe.